Have you ever wondered why some people build massive wealth in the stock market while others lose everything? Is investing really about finding the next hot stock? Or is there a smarter, safer way to grow your money? According to Warren Buffett, the answer can be found in a single book. He called it the greatest investing book ever written. That book is The Intelligent Investor by Benjamin Graham. In today's video, we'll break down the most powerful lessons from this timeless classic in a simple and easy to understand way. By the end of this video, you'll understand how successful investors think, how to avoid costly mistakes, and how to build wealth over the long term. So let's get started. Benjamin Graham is known as the father of value investing and was the mentor of Warren Buffett. What's interesting is that this book isn't about getting rich overnight. It doesn't promise secret stock tips. It doesn't teach market predictions. Instead, it teaches something much more valuable. It teaches how to think like an investor. Graham believed that the biggest threat to your wealth isn't the stock market. It's your own emotions. Fear, greed, impatience, and overconfidence cause more investment losses than anything else. The goal of investing is simple. Protect your money, grow it steadily, and avoid major mistakes. Lesson 1. Investor versus speculator. One of the most important lessons in the book is the difference between an investor and a speculator. An investor carefully analyzes what they're buying. They focus on long-term growth and the true value of a business. A speculator, on the other hand, is mainly focused on short-term price movements. They buy because everyone else is buying. They hope prices will keep rising. Imagine a stock suddenly doubles in price within a few weeks. A speculator says, "I need to buy before it's too late." An investor asks, "Is this company actually worth this price?" Many people believe they're investing when they're really just gambling on price movements. Graham warns that speculation becomes dangerous when people mistake it for investing. Lesson 2. Inflation is quietly stealing your wealth. Let's talk about inflation. Inflation means the cost of goods and services rises over time. If inflation is 5% per year, your money loses purchasing power every year. In simple terms, money sitting idle becomes less valuable. That's why saving alone isn't enough. Your money needs to grow faster than inflation. This is where investing becomes essential. Without investing, you work for money. With investing, your money begins working for you. Lesson 3. Meet Mr. Market. This is probably the most famous concept in the entire book. Benjamin Graham asks us to imagine a business partner named Mr. Market. Every day, Mr. Market comes to you and offers to buy your share or sell his share of a business. The problem is that Mr. Market is extremely emotional. Some days he's excited and optimistic. He offers ridiculously high prices. Other days he's depressed and pessimistic. He offers extremely low prices. The stock market behaves exactly like Mr. Market. Prices swing constantly based on emotions, news, and public sentiment. The key lesson is this. You don't have to follow Mr. Market's emotions. You simply take advantage of them. When prices become irrationally low, opportunities appear. When prices become irrationally high, caution becomes important. Lesson 4. Market crashes are normal. Most investors panic during market crashes. They see prices falling and immediately assume disaster is coming. But Graham teaches that market crashes are a normal part of investing. Throughout history, markets have experienced recessions, crashes, bear markets, and financial crises. Yet they have always recovered over time. The biggest mistake investors make is selling during periods of fear. They lock in losses and miss the recovery. Successful investors understand that temporary declines are often opportunities rather than threats. A market crash can simply mean that quality businesses are available at discounted prices. Lesson 5. Defensive investors and enterprising investors. Graham divides investors into two categories. The first is the defensive investor. These are people who have careers, businesses, or responsibilities outside investing. They don't want to spend hours researching stocks. For these investors, Graham recommends a simple approach. Own diversified investments. Focus on quality and stay invested long term. The second category is the enterprising investor. These individuals are willing to spend time studying businesses, financial statements, and market opportunities. They may achieve better results, but only if they put in the necessary effort. For most people, the defensive approach is usually the better choice. Lesson 6. Do not put all your eggs in one basket. Diversification is one of the simplest ways to reduce risk. Imagine investing your entire life savings into one company. If that company fails, your financial future could be destroyed. Now imagine spreading your investments across multiple businesses and industries. Even if one investment performs poorly, others can help balance the losses. Diversification protects you from unexpected events. It's not exciting, but it's one of the smartest strategies an investor can use. Lesson 7. Margin of safety. This is the heart of Benjamin Graham's philosophy. The concept is called the margin of safety. Here's a simple example. Imagine a house is worth 1 crore rupees. If you can buy it for 70 lakh rupees, you've created a safety cushion. Even if your estimate isn't perfect, you're still protected. The same principle applies to stocks. If a company is worth $100 per share, buying it for $60 is far safer than buying it for $120. The margin of safety protects investors from mistakes, uncertainty, and unexpected events. This single principle became one of Warren Buffett's most important investing rules. Lesson 8. Ignore daily market noise. Every day the media produces endless headlines. Markets are up. Markets are down. Experts predict crashes. Experts predict booms. Most of this information has little value for long-term investors. Successful investors think in years and decades, not days and weeks. If you own a quality business, daily price movements shouldn't control your emotions. Think like a business owner, not a trader. Lesson 9. Don't follow the crow. History is full of financial bubbles. When prices rise rapidly, people become excited. More buyers enter the market. Prices rise even higher. Eventually, reality catches up. The bubble burst. The crowd is often most optimistic near the top and most fearful near the bottom. Graham encourages investors to think independently. Just because everyone is buying something doesn't mean it's a good investment. And just because everyone is selling doesn't mean it's a bad one. Lesson 10. Asset allocation. Graham also emphasizes the importance of balancing your investments. He recommended maintaining a mix of stocks and bonds rather than putting everything into one asset class. The goal isn't maximizing returns. The goal is achieving a balance between growth and safety. A well-balanced portfolio helps investors remain calm during market volatility. And staying calm is often one of the biggest advantages an investor can have. Lesson 11. Emotional control is everything. Many people assume investing success depends on intelligence. Graham disagrees. He believed temperament matters far more. Some highly intelligent people lose money because they panic during downturns. Others become greedy during bull markets. Meanwhile, average investors often achieve excellent results simply because they remain disciplined. The stock market constantly tests emotions. The investors who succeed are usually the ones who stay rational when everyone else becomes emotional. Lesson 12. The power of compounding. One of the most powerful forces in finance is compounding. Compounding means earning returns on your previous returns. At first, growth seems slow, but over time, it accelerates dramatically. This is why patience is so important. Many people quit investing too early because they don't see immediate results. But wealth is often built gradually over decades. The longer you stay invested, the more powerful compounding becomes. Final conclusion. So what is the ultimate message of the intelligent investor? Benjamin Graham teaches us that successful investing isn't about predicting the future. It's not about finding the perfect stock. And it's definitely not about getting rich quickly. Instead, successful investing comes down to a few timeless principles. Buy quality assets. Pay reasonable prices. Maintain a margin of safety. Diversify your investments, control your emotions, and stay invested for the long term. The intelligent investor doesn't try to outsmart everyone else. They simply remain disciplined when others become emotional. And over time, that discipline becomes a powerful advantage. If you enjoyed this summary and learned something valuable, make sure to like this video, subscribe to the channel, and turn on notifications for more book summaries on investing, wealth building, business, and self-improvement. And remember, the stock market is a tool for transferring money from the impatient to the patient. Thanks for watching, and I'll see you in the next video.